Well, the Reserve Bank is widely expected to keep interest rates on hold at 3.5% at its board meeting today. Well, for more on this and what bond markets are expecting, we're joined by Stephen Nash from FIIG Securities. Stephen, great to see you there. I just wanted to focus on some comments that the former RBA board member Warwick McKibben has made. He's part of that ANU's shadow RBA board, if you like. He's kind of going against the trend, and he's calling for the RBA to be raising interest rates to respond to these easing Eurozone debt worries. What do you think of this call? I mean, is it correct?
Look, I think it's probably a little bit on the extreme side, but the market really got it wrong in terms of the last easing, where the market was looking for something between one easing and two easings. I think that sort of discussion is balancing out this almost unbounded dovishness that's in the market right now, or has been, in the sense that the RBA is still concerned about productivity growth. It's noted that wage outcomes are quite firm, unemployment's still quite low, so there are some issues out there that really need to be addressed, and that would probably at the moment mean monetary policy should be left where it is, with scope for further easing depending on what happens in the global scene. I think the domestic situation right now doesn't really warrant any action. We have some improvement in some aspects of the data, but it's really not convincing right now.
So obviously a lot of focus is going to be on the statement. Do you think that we could perhaps see a more hawkish tone?
Look, I think the RBA will probably point out that monetary policy currently is quite accommodative, and that it is continuing to be concerned about productivity growth in the economy more broadly. I think the contrast between the mining and non-mining sector will probably be emphasised again. The recent easings are helping the non-mining sector. We have had some improvement in property prices of late, but I think that's going to be pleasing to the RBA. Large increases probably wouldn't be, but small, modest increases I think are quite pleasing to the RBA.
What about inflation? Because, you know, at the moment it seems that it's under control, but is it really? And how much is that going to weigh in the RBA's thinking then? Look,
given global excess capacity and the reduction in production from the region, particularly China, I think that the demand for mining products is reducing, and the shift towards an inflationary environment is probably not there right now. We don't really have much scope to be really concerned about that. Although we do have quite a low unemployment rate. If that was to lower further, that could be a possible concern, but I think worrying about inflation in an environment where European growth is very weak and affecting global growth is probably not the right way to think about it.
So how should investors be thinking then when they're looking at allocating assets?
Look, I think obviously bonds are something that they should be considering a little bit more seriously. Some of these bonds have done very well last financial year. Inflation-linked bonds, for example, returning around 19% for the full financial year. It's an asset class that investors really don't know much about. They probably should know a little bit more about. Whether those assets will return the same next year is an open question. We'd probably not be predicting equivalent returns, but we'd expect solid returns nonetheless in most of the bond asset classes. So I think bonds are becoming something that people really can't avoid anymore, and equities generally are being avoided. You can see that in terms of what the recent issues have been on the stock market, a lot of debt issues coming out.
So you think that the worries, particularly about Europe then, even though we had the instant euphoria over the EU summit, that seems to be petering out. So you think that perhaps that is just a sign that riskier assets aren't going to be delivering those returns?
I think the problem with risky assets is economic growth. Looking at Europe, it's just a pretty poor story. We had news also out that credit growth in the EU area was down. You can expect that banks that are relying on the LTRO for liquidity are probably going to be more conservative. So what's happening is you've got austerity by the government sector, and then you've got private sector credit being withdrawn at the same time. So the prospects for growth are quite weak, and I think that's what's really affecting equities right now, and probably will for the next year or so.
Even if, we see more stimulus, the Fed coming in with QE3 and that flooding the system with more cash?
Look, I think if we had the Fed intervening with QE3, I think that would get some sort of rally going in equities for a while. I think there are causes for optimism. We've got quite low oil prices. We've got very low interest rates in the US. Housing market is stabilising. And with QE3, we probably could get some sort of rally towards the end of the year. But as we've seen of late, these rallies tend to peter out. They probably should be used to reduce allocations to equities.
Just looking at the manufacturing data in the US, and how worried are you, I guess, about the global picture? If we're seeing that in the US, then, is China slowing a little more quickly than we thought, or will the policy initiatives there be able to support that economy?
Look, I think what's happening in China is that we've had a destocking in industrial production. I think the Chinese authorities are now trying to come up with solutions to a lower growth picture now. I imagine that infrastructure spending will be accelerated. There may be further interest rate cuts, and I imagine that Chinese growth should resume upward trajectory towards the end of the year. Really, also it depends on what happens in Europe in terms of further declines in demand. Hopefully, that could be stabilised and we could get some sort of resolution or interim resolution in Europe, which would inspire some sort of growth in the Chinese economy towards the end of the year.
Do you see too, of course, the oil price had a great session on Friday, but it started to pull back, and it's still, historically low compared to where it has been.
Yeah.
Is that also, does that kind of factor get forgotten sometimes, that also provides a bit of a stimulatory effect, those lower oil prices?
Look, I think that lower oil price is something that market participants are really not considering in detail. Has a very large stimulatory effect. We've got the summer season in the US. We've got lower oil prices, which will feed through to a greater spending in the US. So I think that is a positive that people are really not focusing on right now. And it will take a while to come through, but I expect that this lower oil price is a significant positive for the US.
Stephen, it's great to get your thoughts as always. Thank you so much for that. Lots to watch out for. Dr. Stephen Nash there from FIIG Securities.